Hi there. Welcome back. Today, I want to talk about a very big question that you're probably asking at this particular stage of your journey to real estate investing. And that is, how much house can I actually afford? And how do I even begin to qualify for a mortgage in this day and age? And I want to kind of start off with talking about what lenders' requirements are and understanding those. So they've shifted over the past few years, okay? We've had the crazy housing bust back in the '07, '08 era, and then we had a whole bunch of other stuff, recessions and COVID-19. So some things have changed a little bit over the years. One of those are the minimum credit score, right? I've been talking about that a lot. I have another post where I talk about the minimum credit score. I recommended being above 620. That's kind of the common threshold. And you want to be as far above that as possible, obviously, because it helps to get better terms on your loan. Okay. Number two, there's an increased down payment. So larger down payments reduce the risk for lenders. And so what that means for you is that there may be a higher down payment requirement upfront from some lenders. Number three is re-verification of pre-approved loans. Don't be surprised and be prepared for a situation where there's a last minute re-verification before finalizing your loan. And a quick pro tip is to definitely not open any credit cards or close any credit cards or make any big closing or big purchases. And, just nothing crazy until you've settled on your home. Talk to your lender about what that actually means, but basically no big financial shifts need to be happening when you're in the process of getting qualified for a loan. Okay. And while I do recommend shopping around to get the best, loan and to get the best service, just be mindful about the fact that every time a lender pulls something and does a major inquiry, it does ding your credit score. So let's talk about what you need to qualify for a mortgage really quickly. You're going to need your recent pay stubs. About 2 should be what they ask for. And this is so that they can verify your current income and employment. Next, you're going to need your bank statement. And this shows exactly where you stand. You want to give them all your stuff, your checking, savings, retirement accounts. Next are tax returns. Lenders normally ask for your tax returns for the past 2 years, okay? W-2s, 1099s. And whether you're employed or self-employed, you're going to need to provide documentation to kind of support your earnings for the past 2 years. And along with those documents, you can expect the lender to do a credit check like we mentioned before. Types of mortgage interest rates. So the two I'm going to break down are fixed rate mortgages. Okay, these are the ones where the interest rate stays the same for the duration of the loan. Okay, and then there's adjustable rate mortgages or ARMs. They're also called variable rate mortgages, and these can change depending on particular benchmarks. And this option might make sense for somebody who's a little bit more savvy and not looking to have the loan for long or can handle the financial risk. This is something you're definitely going to want to talk to your lender about just to confirm what kind of makes sense for you. And yeah, what impacts your mortgage rate? Lenders look at a few things when setting your mortgage rate. And so market conditions might play a role, but the biggest factor, I think, is your credit score. So a high credit score, it just kind of puts you in the best situation where you can get the best terms, lowest rates. Other factors are your debt to income ratio and the type of loan you're getting. So certain loan types, like the government-backed ones, such as the FHA, the VA, and the USDA, they do have specific requirements, and they can sometimes be a little bit more flexible with lower rates depending on your particular circumstances. I do want to also point out, though, that the lowest interest rate doesn't necessarily mean it's the best loan for you. So this is just something else you're going to want to dive into real deep with your lender. Now let's talk about how to qualify for a mortgage. Okay, what are the lenders looking for? How do I get in? All right, we just talked about income, and I want to talk about the different kinds of income that lenders will accept. All right, and that would be employment salaries, obviously, commissions, bonuses, overtime pay, all that works. But you can also utilize military benefits, side hustle income, any income stream that you have, child support and alimony, investment income and dividends, trust income, social security payments, disability payments. This all qualifies. Schedule K1, If you have any questions about anything, definitely ask your lender. I keep saying it over and over again, but it really is important that you understand everything that you're signing up for when you're taking on, a mortgage. All right. If you need a lender, do not hesitate to click that button on my blog. I will help connect you with somebody who you can trust. All right. Again, credit score, you got to keep that in check in your debt to income ratio. Again, these are things they're looking at. Assets. All right. So in addition to your income and credit, they're going to want to see that you've got, your savings and assets in line to cover mortgage payments in the event that you have an emergency, right? They want to make sure that you can cover some things for a certain period of time if, say, you were to lose your job or something like that. Property type, that's a huge thing that some people really don't think about. For instance, if you're looking at a condo or a HOA community property, sometimes the fees that go along with those properties, they eat into, how much of a mortgage you can actually afford. So I also want to point out that, if it's your primary residence, there are some benefits that come along with that. So just talk to your lender. Another thing to think about when you're budgeting are closing costs. Okay, so I recommend having somewhere between 3 to 6% of the loan amount. If you can, that's ideal, just to make sure that you can cover everything when you're getting to the end there. Okay, and then additionally, if your down payment is less than 20%, you're going to want to confirm. There's something called the primary mortgage insurance, and you just want to kind of see what's going on with that and confirm with your lender in terms of the cost. So if you feel as though you need to improve your credit score, I do talk about that in depth in a blog post, but I'll just point out some tips again here. I got 5 of them for you. One is to improve your credit score. Again, credit score. 2 is to lower your debt to income ratio. 3 is to save for a larger down payment. 4 is to explore the government loans. Okay, government-backed loans, like I mentioned before, the FHA, VA, USDA, they do often come with a lower down payment and some more flexible terms, sometimes even lower interest rates. So just talk to your lender about that, and if you qualify, that might be a good option for you. I'm going to go right back to the cosigner tip because it's kind of major to me. Network is your net worth. Okay, if you have a family member or a friend that you can work together on getting a deal done, I highly recommend it. If they agree to take on the financial responsibility with you, sometimes it can help you out with qualifying for a loan. So to wrap this all up, to pull it all together in a neatly done package for you, I want to leave you with 3 P's. That is to plan, prepare, so you can prosper. Okay, so this whole thing might seem a little bit overwhelming at first, especially for people who are just beginning to even explore this possibility of homeownership. But once you kind of get everything sorted out, it's really not so bad. If you have any questions, feel free to reach out, look at my blog, peruse, and reach out if you need anything.